Most investors spend their time trying to predict where the market is going. Will stocks go higher? Will interest rates fall? Is now the right time to buy? While direction gets most of the attention, professional investors often focus on something entirely different: volatility. In fact, volatility may be the single most overlooked component of successful investing. Today we're going to explain what volatility really is, why does it matter, and how understanding it can completely change the way you think about investing. Hey, it's Frank Nagy and welcome to my channel where we help investors understand various markets, risk management, and alternative investment strategies. If you're new here, subscribe to my channel and hit that like button. When most people hear the word volatility, they immediately think of risk. They picture market crashes, sharp sell-offs, and large swings in their portfolio. But volatility itself isn't risk. Volatility is simply the rate and magnitude of price movement. Think of it like the weather. There are two cities may have the same average annual temperature, but one experiences calm, predictable seasons, while the other seems to be constantly in storms. The average may be similar, but the journey is very different. Markets work much of the same way. Prices can arrive at the same direction and distinction through entire smooth movements or violent swings. Professional investors study those swings because they create opportunity. Volatility influences nearly every investment decision. It affects portfolio risk. It influences asset allocation. It impacts position sizing. And in many market strategies, it directly determines expected returns. Yet many investors ignore it entirely. Instead, they focus solely on whether they believe the market will go up or go down. And that's only half of the equation. Understanding how much the market is expected to move can be just as important as predicting the direction. This is one of many strategies Theta Bridge Capital Management applies when managing non-directional investment portfolios with a focus on risk management and market analysis. The firm's objective is to develop structured investment approaches grounded in portfolio construction, risk control, and long-term capital growth. There are two primary types of volatility. The first is historical volatility. This simply measures how much prices move over a certain period of time. It's backward looking. The second is implied volatility. This represents the market's expectation of future movements. When investors accept major events or become nervous, implied volatility tends to rise. When markets become calm and confident, implied volatility usually falls. Professional investors monitor both because the difference between expected movement and actual movement often creates investment opportunities. Let's look at an example. Imagine two companies with identical earnings, growth rates, and identical valuations. One stock moves less than 1% per day, and the other regularly swings 3 to 4%. Would you value those investments the same? Probably not. The second investment carries much greater uncertainty. That uncertainty affects the pricing, portfolio allocation, and expected returns. The same principle applies across the entire financial market. One of the biggest mistakes investors make is reacting emotionally to volatility. Markets decline, headlines become frightening, and investors panic, and decisions become emotional instead of disciplined. Successful investing requires understanding that volatility is normal. History shows that markets experience periods of calm followed by periods of elevated uncertainty. These cycles repeat over and over. Rather than fearing them, experienced investors prepare for them. This is where risk management becomes essential. Risk management isn't about avoiding losses entirely. That's impossible. It's about controlling exposure before uncertainty arrives. Professional investors often determine how much they are willing to lose before entering a position. They diversify intelligently. They size positions appropriately. They understand correlations between investments, and this is the key part of the whole strategy. These principles become even more independent and important during periods of elevated volatility. Some investment strategies are designed specifically around volatility rather than market direction. Instead of asking whether the prices will rise or fall, their approaches seek to benefit from changes in uncertainty itself. Institutional investors have used volatility-focused strategies for decades. Why? Because volatility behaves differently than price. Markets can move sideways while volatility rises, and markets can rally while volatility falls. Understanding these relationships create opportunities that many traditional investors never consider. Another important concept is that volatility is constant. It expands, it contracts, it moves in cycles. Periods of unusually low volatility often lead to higher volatility later. Likewise, periods of extreme volatility frequently settle down over time. Recognizing these cycles helps investors avoid making emotional decisions at exactly the wrong moments instead of chasing performances. Disciplined investors accept this risk based on changing market conditions. The key takeaway is this: successful investing is not just about finding the next winning stock or deal. It's about understanding the environment in which your investments operated. Volatility influences every portfolio. Ignoring it doesn't make it disappear. Learning to measure it, monitor it, and manage it can significantly improve your investment process. Whether you're building a retirement portfolio, managing institutional assets, or simply trying to become a better investor, understanding volatility gives you another lens through which to evaluate opportunity and risk. And that's what Theta Bridge Capital Management is all about. And that's exactly how many professional investment managers approach the markets. They don't simply ask where prices are going. They always ask how uncertain the journey is likely going to be. Sometimes that difference is really where the real edge exists. Hey, to learn more about Theta Bridge Capital Management and our investment strategies, risk management approach, and portfolio construction, click on the links below in the description box.